Good morning. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from the Shoal Lake 40 First Nation in Treaty 3 territory. My name is Neil Harden. I'm chairing today's panel. With me in the room is Brent McIntyre and Robert Upton. The assessor today is Nathan Kupfer, and the recording secretary is Belen Rojo. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application and will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking on matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it in the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions the applicant may have, then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We'll be hearing items 1 through 7 on the docket today. Ms. Rojo, please affirm the assessors and the applicant's testimony.
Mr. Assessor, please state your full name.
Nathan Kupfer.
And you affirm the evidence you're about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Applicant, please state your full name. And you affirm the evidence you're about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
All right. So the first property on today's agenda is 420 Pembina Highway. So Mr. Kupfer, you can begin on this property.
This is roll number 120206351100, street address 420 Pembina Highway. This property is owned by Manitoba Public Insurance Corporation. It's a commercial office building, only one story, constructed in 1974. Got a leasable area of 23,510 square feet and a modeled 2023 assessment of $4,435,000 that I'll be recommending be maintained today. If you scroll to page 2 of my brief, you can see that we have no recent sales to go off of for this property. I've provided a Google Street View as well as an overhead of the properties. You can see it's right along the north part of Pembina there, the 400 block. We have this classified as an OFS suburban office as it's located outside the downtown. I provided for you a general sample size here of our OFS properties, including some that are along Pembina Highway and kind of in the same area as well. An average and weighted average is calculated on the sample size of around $16, a median of $15, and a min-max between $10 and $22.50. These are all net leases, so we haven't made any adjustments to them. It's exactly as been reported to us. So like I stated, this is an OFS property. Page 8 of my brief has our modeled workup here. Because it's MPI, we can see that C7, the government agency tenant class, which tends to run slightly higher than a general office tenant class. I think generally because governments tend to take good care of their space and pay slightly more on their leases. I believe the C6, the storage there is in the basement, so it's being afforded a lower rate. The average here, the potential rent of $352,835 works out to an average rental rate being applied here of just over $15 for the space. We have a vacancy of 6%, expenses of 3%, shortfall of $8, and a capitalization rate of 7%, which I feel is quite reasonable. And that derives that 2023 modeled assessed value of $4,435,000 using the income approach. The space is primarily, like I said, owned and occupied by MPI. They do list one tenant on their income and expense mailer here. I provided in my brief, Mitchell International. I'm not overly familiar with the tenant. I had a bit of a chance to look them up on Friday. I got off their website here. Mitchell simplifies and accelerates claims management and collision repair process through the broadest range of technology solutions, networks, and partners in the PC industry. So I believe that they're a related party. They indicate that it's owner occupied. I'm not entirely sure. We can ask the agent for some more information here. They're indicating to be paying $22.50 a month. Sure, it works out to an annual rate of $14.95. They check off all of the expenses, but also say that it's owner occupied, and then they don't provide the expenses that were paid. At least I wasn't provided a copy of it through the income and expense mailer. Just this this page showing the tenants and this rent information. So that's all the information that I have to go off at this point. And again, I'm going to recommend that modeled assessment be maintained. Thank you.
All right. Questions, Mr. Reimer?
Thanks, Mr. Chairman. Mr. Kupfer, could we go to page 8 of your submission? And I just want to clarify, because the total area we have is very close. We actually have it a tick higher, but the main floor premise, that's the 11,903 square feet? Or is it? I guess I'll rephrase that. The basement area that the departments used, you've got 3,357 square feet. That's basement storage, correct?
It's being classified as basement storage area, correct?
Okay. And then how much of either the premise 1 or the second premise, how much of that is basement space?
From what I can see here, the C6, the 3,357, doesn't encapsulate all of the basement space. Right. So this indicates to me that MPI is taking up part of the basement space as office as well, and only part of it is being used as storage.
And I agree with that, but I guess my question, just because the areas that the breakdown is different than what you've got, do you have in the department's records then the amount of basement area either in the first premise or the second premise of the totals you show on page 8?
I do. I didn't make note of it here. I can see in your brief you've got 7,810 square feet.
I do.
Which, yeah, I'll accept that as I continue to. I'll pull it up here in the background as we keep going.
Okay, so roughly, in very, very rough terms, roughly 4,000 square feet, or I guess 4,500 square feet of one of those two premises, the first two that is, would be basement area. And then the rest of the parameters, in fact, including the potential rent, the entire evaluation is model driven from potential rent down through cap rate, correct?
That's correct.
And do any of your rent comparables also have basement area included in them?
I didn't make note of which ones have basement and which ones don't.
Okay. Mr. Chairman, those are my questions on this property. Thank you.
Okay, Brent, any questions?
Just one question. The lease expired for this tenant/owner occupied in 2021. Was it renewed?
Was it renewed beyond 2021? I would have to pull up that post-reference income and expense mailer, Mr. Chairman. It would take me a couple minutes. If you'd like, I can.
I don't know if it's post-reference. Should we be considering it? I don't think we should be considering anything that's post-reference.
No, I agree. I just had written down 2021. I didn't put, I think it's September 2021.
Yes, yeah,
That's what I'm showing, yes.
Yeah, in my notes, I just wrote down expired in 2021. So no, I'll withdraw the question.
Okay.
Okay, anything more?
Nope, that's it.
Okay, Bob, any questions?
Yes, it's all model driven, you said?
Yes, sir.
Okay, and it's based on all your comparables that you've listed here? The rental is based on all your comparables? Or you're sticking off the model?
The rental rates that are being supplied on my page 8 there, that's all model driven. Our model rates are, of course, derived using the income and expense information that we receive and use to build our model.
Plus the comparables you've listed?
That's right. So I haven't physically made any adjustment here, but I do believe that our office rent comparables here do support our rental rates that are being modeled.
Okay, thank you.
Okay, I just want to get a little clarification on the areas then. Which one of the units has the basement office area?
Is it Mitchell or is it MPI?
Yeah.
I'm not 100% sure on that.
Okay, I'll clarify that with the applicant when the time comes.
Okay.
Okay, I have no other questions, so Mr. Rammer, you can begin.
Thanks, Mr. Chairman. And what I'd suggest is the common theme to all the properties would relate to the non-recoverable expense allowance. And with your approval, I'd suggest I go through that once at a very high level, and then ask that those comments and questions be carried forward.
That is fine.
Okay. In this case, capitalization rate is not actually at issue. I'll perhaps go through the capitalization rate study again for the purposes of the board's information for the hearings this morning, knowing that cap rate is not an issue for this particular property, but may as well go through it. Unless, Mr. Chairman, you disagree, I might go through it now with this hearing, the one time, and have it carried forward.
Okay.
Could we briefly go then to page 14 of our submission, our main submission, that is?
Okay.
This gets to the question that I posed to Mr. Kupfer concerning the areas. And what we've got, the Mitchell International, I'm going to take a half step back. Mitchell International, as far as I'm aware, is not related to MPI. They are a third-party tenant, and I'm not entirely sure why MPI would have responded with a Y in the owner occupied. They certainly occupy the remainder of the space, but Mitchell International is an arm's length third-party tenant, as I understand it. They're paying a gross rent of $14.95 with the estimated costs, and these are just rough estimates, of call it, I think I estimated it at $7 a square foot even. The net rent being achieved is less than $8 a square foot. We have chosen to apply a significantly higher market rent to that space, but they are in fact a third-party tenant paying significantly less. So on page 14, the area breakdowns that we have are 1806 for Mitchell, and they're on the main floor, and then the remainder of 14,254 being owner occupied, and the total basement area, including both the finished areas and the storage, of 7,810 square feet. So our total area is actually about 360 feet higher than the departments, but the breakdown is as we show it there, with a significant component of that being basement area. So what we've done is applied the $12.50 square foot market rate to the entire main floor area, both the Mitchell space, notwithstanding their paid rent being lower, and the MPI occupied space. And we've applied, a total blended net market rent of $750 to the basement area. That's the combination of the storage and the finished space. So the total potential rent that we have on the property is $259,325. If we briefly go to the prior page, it's page number 13. So we've got comparables showing on the top chart for main and upper floor space, ranging between a very low rent of $278 to a high of $1,729. Interestingly enough, the lowest and the highest rent are within the same building, but be that as it may, we have several rents, and you can see, Mr. Chairman, most of them obviously are in that $9.35 a foot to $15 a foot range, based on the size of the larger size of the subject, the main floor premise at just over 14,000 feet, and again applying the same market rent to the Mitchell space. We certainly believed in the context of these rents that were negotiated between 18 and 2020, that is, that the $1,250 was reasonable. The finished basement, recall the question I had of Mr. Kupfer related to the rent comparables with the finished basement. I wasn't, from my research, and I'm not going to suggest I had the time to be comprehensive, but I didn't see any premise that would include the basement space. We've specifically provided the board with these basement rents ranging from a low of $466 a foot up to a high of $15 a foot for a very, very small premise of 336 square feet. The three largest premises that are basement areas are the top three of between $7 a foot and $860 a foot. So we've selected a market rent of $750 for our total basement area of 7,810 square feet, again, including both the finished office space and the storage space. So we certainly believe the $750 is very reasonable. Turning then to page 15. So as you can see there, we've got a total potential net market income of $259,325. The vacancy allowance for the market vacancy allowance for the suburban office at 6%, shortfall rate at $8. We are including, for the reasons I'll get into very shortly, the full 5% for non-recoverable, 2% for other, and in this case, we don't disagree with the 7% capitalization rate applied by the department. A significant component of this rent, the total potential rent, does relate to basement area, which at the best of times is difficult to lease. And certainly we believe the 7% rate in that context for this income stream is appropriate. So then turning very briefly to, if I could ask the board members, Mr. Kupfer, to turn to our non-recoverable expense study.
Okay.
And so as I mentioned, Mr. Chairman, I'm going to go through this from a very high level. If we turn to page 3, we looked at what we believe, continue to believe, is the original intent of the allowance. And in one of the assessor's earlier manuals, they state on the second paragraph on page 3, however, even on a net rental basis, there are a number of areas where the property owner must cover expenses. Thus, the effective market income must be reduced by the amount of these unrecoverable expenses to determine the net operating income. And that's in our submission what we're doing in the case of this allowance. Then skipping ahead to page 5, we also looked at appraisal theory, and at the bottom of page 5, the office property valuation text talks about leasing and capital costs. And it states the appraiser should also account for non-recoverable expenses, also called non-rechargeable expenses. Most important non-recoverable cost items to be aware of are space marketing costs, which include both tenant inducements and leasing costs, and an allowance for structural or mechanical repairs. So in our submission, the 2% quote-unquote other allowance is the structural repair allowance that we are continuing to apply. And what we're doing in our analysis with the 5%, we are not specifically, and I say this very specifically, we're not including tenant inducements, but we are including leasing commissions, advertising, marketing, and professional fees, and in a few limited cases, asset management fees. Then we looked at some of the other provinces. If we skip to page 7 now, at page 7, there's some expense items that are quoted by the Saskatchewan Appraisal Authority, and they state non-recoverable operating expenses are typically not recovered from tenants are as follows: legal and audit fees, which is the professional fees I mentioned, structural repairs, which we're submitting is covered by the 2%, advertising and promotion, which we're also including, and leasing commissions, which again we're also including. Then we looked at MPAC, which is the Ontario Assessment Authority, and on page 8, out of the impact manual, the second paragraph, the manual states there's typically two areas where the property owner has to cover expenses: non-recoverable operating expenses, which are not passed on to the tenants, such as legal and audit fees, advertising and promotional fees. And they go on to say expenses associated with operating any vacant space. That, of course, is covered in the shortfall allowance. So that expense item is covered off in both our submission and the submission of the assessor. So then turning to page 10, we state there are the four items that we are including in our analysis, and those are leasing commissions, professional fees, where applicable, asset management fees, although there's not very few properties that have those, and advertising, marketing. Page 11, we have the analysis, the conclusions based on, and again, I haven't corrected that yet, but it's actually, for the most properties, it's a 5-year stabilized average, updated from the previous cycle and additional 2 years added onto it. So in the second column from the right, and I stress this, that's the column that we're focused on. That's the percentages without any tenant inducement allowances included. And that has an average of 6.64% and a median of 5.98. For the board's information, on the right-hand column are the same analysis, but including the TI allowances, and there, of course, the percentages are much higher still. Again, I stress we provide that for information, but we're not relying on it in any way. Turning then to page 12, pages 12 through 15, this is the analysis that we've done should the board decide, and it's obviously, I've said this before, it's certainly within the board's prerogative to reduce the non-recoverable expense allowance from 5% to 1% as the department's done. That, though, has a direct bearing on our capitalization rate request. The reason for that is that we've included in our analysis the full 5% allowance, and the mathematical effect of reducing the 5% to 1% is to increase the cap rate. So I've provided a specific example in pages 13 to 15. These examples all use the very same assumptions as to income, expense allowances, vacancy allowances, and the same purchase price. The only change between among the three examples that I provided relates to the 5% non-recoverable expense. So on page 13, using those set of assumptions I lay out at the top of the page, the indicated capitalization rate with the application of the full 5% allowance is 7.38%. Then turning to page 14, if one reduces the 5% allowance to zero, this using the exact same assumptions for all of the remaining valuation, including the sale price, the capitalization rate increases to 7.79%. So that's fully 41 basis points. Then, probably the most germane to this discussion this morning on page 15, we have again the same set of assumptions with the reduction of the 5% allowance to 1%, and the indicated cap rate is 7.71%, which is an increase of 33 basis points. So my request, Mr. Chairman, if this board were inclined to reduce the non-recoverable expense allowance from 5% to 1%, then please take that as our request to increase our capitalization allowance by 25 basis points. Notwithstanding that mathematically the increase is actually a bit higher, typically between 28 and 31 basis points, we're just simply rounding it to a 25 basis point request in our valuations. So then, for capitalization rate, and I should ask, Mr. Chairman, if cap rate's not an issue, do you want me to wait until it is an issue, or do you want me to just cover this off now?
I really think we should probably wait till next property when it is an issue.
Yeah, I understand. Totally understand. So then, going back to page 15 of our main submission.
Okay.
Again, applying the $1,250 for all the space above grade, including the Mitchell space, and $750 for the basement area, both the finished and storage as a blended rate. Running it through using the full 5% and the 7 cap, we request a reduction in the value to $3,074,000. Pardon me, $3,075,000. Thank you very much.
Okay, questions, Mr. Kupfer?
Yes, please. I'm looking at page 13 of your main brief here.
Yes.
Stating that the rental rate was $14.95, and then after deductions for expenses, you've netted this down to $7 a foot. But I didn't receive expenses for this property. How is a $7 a foot figure derived?
Yeah, it's a good question, Mr. Cupper. It's purely an estimate based on the typical suburban office CAM and operating costs. So you're right, it is an estimate.
So you're estimating that this is a $7 a foot net space, basement and main floor inclusive?
No, Mr. Cupfer, the rental rate was only that small unit for Mitchell, and they're on the main floor only. So we haven't used it, but if we were to apply the rental rate actually being achieved, it would be for that small main floor unit of 1,806 square feet. The net rent actually being achieved is somewhere in the $7 to $8 net range. We've applied $1,250.
To you, in your mind, does $7 a foot net for main floor 1,800 square foot space align with your comparables and your understanding of the marketplace?
With this particular property, Mr. Cupfer, and I haven't. Yes. No, that's why we applied $1,250 in lieu of the actual net rent being achieved.
Okay. You said you're applying a blended rate for the basement here, so we're acknowledging that part of it is storage and part of it is used as office. The office would be higher, the storage would be lower. 750 is where you blended it. Yeah. What can you tell me about this comparable on Nassau Street that has both a $2.78 rent and a $17.29 rent? Are these actual net rents, or is this a calculation that Altus has made?
These are our actual net rents, and actually this property will be on the docket this morning, Mr. Cupford. That property has had, as we're going to hear, significant issues, and the owner, of course, is trying to do the best they can with it, but they've also had some vacancy issues. So there is a very wide range of rents, and as you might recall, I am not suggesting in any way that the 278 represents a market, but in fact is that's a property very close by, and it is one of the rents that was negotiated near the reference date.
Okay. That's all the questions I have. Thank you.
Okay, Bob, any questions?
No, I don't think I do. Thank you.
Brent, any questions?
I don't have any questions. Thank you.
Okay, I just got one question then, and probably it's more for the city than Mr. Ryman, but I'll give you a chance to start with it. The tenant, that's independent, non-government tenant, is it?
Yes, that's correct.
Okay, the question I have then is the classification of the property, should that be modified to reflect that it's not all total government?
That is a fine question I haven't considered, quite frankly. I mean, at the end of the day, Mr. Chairman, notionally it could change from a government office to a suburban office. I suppose it wouldn't have any effect on the taxes. Obviously, the tax rate is identical for those two because it says fully taxable or grantable. I haven't considered the question. I guess from my perspective, it wouldn't change my valuation in any way. Put it that way. That's probably the best answer I could give you.
Yeah, and I would. Yeah, I mean, since no one has appealed the classification, we wouldn't deal with that today. But that was just a question I had. Mr. Cupford, do you have any thoughts on that question?
I would say based on the description that I read on their website, based on how they filled out their income and expense mailer, and based on the purported rent that they're paying, I would suggest that they're likely not a fully arm's length tenant, and we should be using marketplace rents for this property.
Yeah. Okay. All right, but it wasn't brought up, so we'll leave it at that. All right. Any summation that you wish, Mr. Kupfer?
None for me, thank you.
Carrie, any questions?
No, thank you.
Okay.
No, thank you.
Thank you. Then let's move on to the second property, which is just down the street or up the street, 701 Pembina. Let me just open the files. Okay, on 701 Pamela, then, Mr. Kupfer, you can proceed.
This is roll number 1201-2595-000. Street address 701 Pembina Highway. This is again a commercial office building, 2 stories, constructed in 1988. We have a leasable area of 5,000 square feet, out of a gross floor area of just under 5,500 square feet, and a model 2023 assessment of $1,135,000 that we'll be recommending be maintained today. Scrolling to page 2 of my brief, there appears there was a 2015 sale for the property at $935,000. I didn't get a chance to do a deep dive on that. I provided a Google Street View as well as our overhead. Again, we're located right along Pembina Highway here. The office rent comparables table I provided for you is the same with the last property. No government tenants in this property, so it's all C2 standard finish for tenant class. We have the property broken down into 4 different premise IDs, some of them a bit larger, some of them a bit smaller. Generally speaking, the smaller ones tend to trend upwards in dollar per square foot, and the larger ones tend to trend a bit lower. We've got a 6% vacancy, 3% expenses, $8 shortfall, and for this one, a capitalization rate of 5.95%, which derives that value of $1,135,000 using the income approach. The income and expenses here were submitted online and appear to include some items that we wouldn't include as acceptable, such as depreciation, loan interest, and bank fees. I believe one of the suites is also owner occupied. So I haven't done a site-specific workup here with the rents. Again, they're not net rents, and I haven't reviewed a copy of the lease. So we're going off of market data here, and I'm going to recommend that model value be maintained. Thank you.
Okay, questions, Kerry?
Thanks, Mr. Chairman. So, Mr. Kupfer, you just alluded to it, but this is again model driven right from all the rents down through cap rate, correct?
Yes, sir.
And this on your page 8, just to be clear, this is a 2-story office building. I believe we established that. The second and the third premises, those are the 2 that are on the second floor, correct? I believe they are.
I would suggest that that's correct.
Okay. And again, these are model driven without reference to what the actual lease is in place at the subject, correct?
That's correct.
And briefly going to your page 10. So the department's provided a summary of the conclusions here on page 10 under all the categories, but I'm focused on the office now. But the department hasn't provided you with the properties that were used in the analysis, correct?
Correct.
Mr. Chairman, those are my questions. Thank you.
All right, questions, Brent?
I have no questions, thank you.
Bob?
None right now, thank you.
All right, I guess just on the cap rate, you've got 5.95%, which is close to the lower 20th percentile, certainly closer to the 20th percentile than the 80th. What would make this property towards the upper end of the or the lower end of the cap rate scale as opposed to the higher end?
It's a good question. I don't think there's anything special in particular about the property or the building. It's well located. It's fairly new, built in the late 80s there. Beyond that, I don't really have any further explanation.
All right. Okay, Mr. Reimer, then you can begin your presentation.
Thanks, Mr. Chairman. If we could go, just to frame the discussion, if we could go initially to page 15, please, of my main submission.
All right.
I'm sorry.
Page 15.
Yes, please. And that should be the income approach summary. So on page 15, Mr. Upton, are you good? Oh, sorry.
On the appendix? No.
Further up. Right there.
Okay, I got it. Thank you.
Thank you. Thank you. So on page 15, just to frame the discussion, the issues in this case are the potential market rent, the non-recoverable expense allowance, and in this case, the capitalization rate. We've applied a total potential rent of $61,048. This specifically is inclusive of the rents that are actually being achieved in the subject. As Mr. Comfort alluded to, there's some gross rents in there, so we've taken out the gross lease costs. We've applied a $15 market rate for the main floor area that is owner occupied. And that then, as you can see at the top of the valuation, results in a total suggested potential rent of $61,048. Applying a market vacancy allowance of 6%, running it through as shown with our expense allowances, and capped at 6.5%. Our suggested value this morning is $784,000. If we turn back briefly to page 13. And I'm guessing Mr. McIntyre, based on past experience, has noticed this, so I'm going to correct it now before I give him a chance to tell me about it. On the first paragraph, the second sentence, it says the potential annual net rent that we calculate is $56,548. That's wrong. Obviously, the potential rent we're calculating is $61,048. So I ask that that be changed to reflect that corrected figure. That figure, in turn, is based on the net rents being achieved. As you can see there, we've got this very small unit on the main floor of 300 square feet. And I agree with Mr. Kupfer's comments. Typically, when you're talking about economies of scale, it works both ways. And when you've got units that are as small as 300 square feet, one would expect that the rental rates, everything else being even, the rental rates would be higher. And that is borne out by the information you can see here. So we've got the 300 square foot unit at the highest net rent of $17.12. We've applied a $15 market rent for the owner occupied spaces, which is also on the main floor, much larger area of 1,800 square feet. And then we've got the two second floor tenants. One is at $10 a square foot under a August 2016 lease, and the other is at $9.95 a square foot under a July 16 lease. We again provided, these are the same comparables we provided with the previous appeal, ranging from the low again of $278 up to a high of $1,729. The average and median being $1,262 and $1,362. So based upon that, referencing those comparables, but then looking at what's actually happening, we suggest certainly what's happening within the property is entirely consistent with that range, and we're applying the rent of $61,048. So now we've gone through, and again, I ask that the information concerning non-recoverable expense be carried forward. So if I could then ask the board members, Mr. Kupfer, to turn to our office capitalization rate study. Let me know when you're there, Mr. Chairman.
Yep, I'm there.
We're good?
Yeah. I have it open, yes.
Yeah, where's the cap?
It's
Right. Oh, at the back?
right here.
Okay, got it.
Okay. All right. So I'm going to go again at a very high level. I know the board's heard this several times in the past. If we go to page 5 initially of the cap study, what we've done, and this is something we typically do every cycle, we take a look at the broker reports, but, and I stress this, it's not for the purpose of actually focusing on the numbers that they have presented in their materials. And the reason for that being that the methodology that the brokers use is different than the methodology employed by the department and by ourselves, and that there has a direct impact. You've got to compare capitalization rate numbers, apples to apples, and to take the actual numbers from the broker studies would not, in our opinion, be that kind of fair comparison. By way of example, Colliers includes closing costs, and if that then is taken out of the equation, which would be because of the way we do the analysis for our purposes, that has the effect of actually lifting the cap rate by roughly 25 basis points. So all that being said, the reason that we put these charts in is actually the issue of interest to us relates to the trends that the brokers are seeing. In pre-pandemic, this chart on page 5 in the middle of the page, pre-pandemic, between 2016 and 2018, there was typically there was no compression in the capitalization rates during that period. What Colliers in Q1 of 18 did say, and this is the last paragraph on that page, is that the office sector is expected to see some changes as we move through 2018. Tower 1 of True North Square continues to lease up during construction and is expected to compete in late 2018. The result of this additional office space will most likely be increased vacancy within downtown and downward pressure for rental rates for Class A buildings. Of course, that in the case of the subject, we're not talking about the downtown area, but at the end of the day, the overall office market obviously is going to be significantly impacted by the addition of that space. Then turning to page 6, and again, this is all pre-pandemic information. We've got a total of 5 transactions that we had analyzed. And as you can see on the chart on page 6, they range from a low of 6.49% to a high of 8.94% for those office properties on that page. The conclusion then, for our purposes, for the suburban office capitalization rates, and the bulk of these, with one exception, are suburban offices. So at the top of page 7, our conclusion for the prior assessment was that suburban office cap rates should be somewhere in the order of 6.25 up to 7.5 at the higher end. Then we turn to page 8, and we have quite a bit of information concerning the environment in which we're now discussing, being, of course, the environment relating to the pandemic. And in the first paragraph, top paragraph of page 8, we talk about the very, very fundamental change to the office model, which directly impacts vacancy, or I shouldn't say vacancy, but directly impacts the office market throughout the city, and for that matter, throughout the country and the entire North America. The hybrid work model, which was it was of course implemented by necessity when the pandemic came upon us, and it became very entrenched very quickly as companies learned that, hey, this model and this remote working environment actually works. And then on the other side of the equation, employees saying, hey, this hybrid work model is something that's quite attractive for us, and we want to continue that. In the first paragraph, there's a reference to the Avis and Young report, and they state that 67% of employees want to work in a manner that's more balanced. This transcends to the return to the office where flexibility and choice are key. Then there's a Western Investor article that we reference it towards the bottom of page 8, and they're talking about Winnipeg, and they say the office vacancy rate in Winnipeg is around 13%, just slightly higher than 19, but the outlook for this year is uncertain. Again, they talk about the wild card being the addition of True North Square and the additional office tower that's going to house Wawanesa. And they go on then in the third paragraph to say that Winnipeg saw a negative lease up in 2020. And the key for us here, though, and this would be, of course, across the board, both downtown but throughout the suburban areas as well. In the second last paragraph is many tenants have opted for short-term leases or extensions of existing leases. Colliers Canada said it's hard to get a clear picture of the timeline for relocation or lease renewals going into 2021. On page 9, then, we reference a survey that Altus had conducted with the top real estate managers and investors throughout the country. And these are very, very sophisticated investors that would have a very, very valuable perspective on the impacts of the pandemic on the office market, and more importantly, as of sort of the end of 20 and going into Q1 2021, what their expectations were. The survey was structured around 2 different sets of data. The first survey was conducted in April of 2020, sort of very early on as the pandemic was just gaining momentum, as it were. And the second one being in November of 2020, when the pandemic was obviously a part of the day-to-day perspective of all real estate participants, both in, investors, managers, and tenants. And at the bottom of page 9, they talk about the hybrid work model and the longer-term effects. And these respondents to this survey confirmed that they indicated that 57% of the respondents to this survey expected office tenants to downsize their space in the future. And that, of course, would have a direct bearing on the vacancy rate for one thing, but more importantly, the capitalization rate. That fundamentally, that sort of perspective of the hybrid model and the reduced space requirements running across the board would directly impact the risk attributable to the office properties, including the suburban office properties. On page 11, and this again, these are the results of the survey that Altus had conducted in April and again in November. Page 11, the question posed was, what percentage change in market rents or face rates are you forecasting for 2021? And as you can see in the the top chart for top quality office, and this would be both the downtown and the suburban top quality offices in November being in the suburban office category, the dark bar, roughly 37% thought there'd be no change, but a significant number thought in the sort of the 28% range thought the rents would decrease by 5%, and another, call it 23% thought they might decrease as much as 10%. And for the lower quality office, the significant, again, proportion thought there'd be no change, but as one might expect, there were very, very significant numbers thought that there were decreases in the rates of between 5 and even upwards of 10% or more. The capitalization rates, the question was posed concerning the office capitalization rates and what the expectations of these investors and managers was for 2021. And the responses were very, very clear that increases in the capitalization rates were expected. Turn to page 12. For the high, again, this is broken out sort of in very broad categories, the higher quality office and lower quality office. The top chart indicates the higher quality office, where in June, a significant percentage, it was roughly 68%, thought that cap rates would increase between 25 and 50 basis points. That had actually dropped to some extent in November, where 25 to 50 basis points were now comprised of roughly 55%. But what you can see there is that a higher percentage actually were more pessimistic. Roughly 28, 29% thought cap rates would increase for higher quality office between 50 and 75 basis points. So overall, the outlook actually had become less optimistic in the November survey. For lower quality office, and again, as you'd expect, the results are much more pronounced, where the fully 50% of the respondents predicted that cap rates would increase between 50 and 75 basis points. Roughly another 30% thought they'd increase between 25 and 50, and significantly, roughly 15% thought they might go up as high as 75 to 100 basis points. So very, very uncertain climate in the pandemic reflected in those responses. Then if you turn to page 16, recall that I had earlier, we had a number of transactions pre-pandemic, and here on page 16, we've got 3 transactions within the pandemic. And as you can see there, they ranged from 6.97% to 7.66% for the 3 properties that are shown there. So the conclusion that we've come to through all of this and taking a look at the pandemic and the very, very uncertain environment for the office real estate sector, for Class S properties, the range that we're suggesting is between 6% and 7.5%. So then turning back to now our original, our main submission on page 15.
Page 15. Okay, yep.
The conclusion we've come to based on... Oh. Sorry, Mr. Chairman, tell me when you're ready.
Yeah, I'm ready, yes.
Okay. So the conclusion that we've come to in this case, based upon the analysis that we've done, is that 6.5% for the subject would represent an appropriate rate, and therefore the indicated value that we're suggesting this morning is $784,000. Thank you.
Okay, questions, Mr. Kupfer?
Okay, so this workup you've done uses a net operating income of just over 50,000, and we're saying this is based on the rents that are in place, other than the owner's space, obviously, where you used something based on comparables, correct?
Yes, indeed.
Okay. So you've included the 2020 and the 2019 income and expense mailers here. For 2020, they report an operating income of $13,950. That's including $38,000 in depreciation and $32,000 in bank fees and loan interest. So would you agree with me that's about $84,400, including the depreciation, the loan interest, and the reported net operating income for 2020?
Absolutely. Without question. Now, recall, Mr. Kupfer, that two things. If you turn to page 19, so the page you were just referencing, which was page 18, if you turn to the following page, the Wellington office space is the owner occupied or the affiliated space. So that has the result of two things. It very much hugely inflates the rent or the income they're reporting on paper. And the other thing, of course, is that this is based on full 100% occupancy with absolutely no deductions for vacancy or any non-recoverables or shortfall or anything. But yes, mathematically, you're absolutely right.
So in this case, the owner occupied space is being over-reported on the book rent instead of under-reported like you would typically see?
The owner's no, I don't agree that it would be underreported, Mr. Kupfer. I suggest actually the affiliated spaces are typically based on rents that are higher than what you're going to achieve on the market. There are specific income tax reasons to allocate revenue from a holding company, from an operating company to a holding company. So I would suggest actually the trend that certainly what I've typically seen is that the rent on paper between these affiliates is higher than what would be expected from an actual third party unrelated party. So if you turn to page 13, and I'll illustrate this by this property. If you turn to page 13 briefly, recall that I applied a net market rent of $15, but the actual net market rent for this affiliate that's in occupancy is $32. And I'd suggest in no uncertain terms that is completely unrealistic from an unaffiliated third party arm's length party.
You're suggesting that the discrepancy between the reported operating income and your operating income is the book rent being used for the owner occupied space is higher than market?
The affiliated space is much higher than market, and of course, what they're reporting is on the income and expense questionnaire that you reference is based on full 100% occupancy with no deductions of any kind for vacancy or shortfall or non-recoverables or anything.
Okay, so we're not using the income and expense mailer information in this case because of that.
No, we are. We're using the rental information from the tenants that are non-corporate affiliates on page 13.
Okay. I have no other questions. Thank you.
Okay, Brent, any questions?
So the owner occupied, just one question, is Wellington Altus?
Yes.
Is that a related company to Altus?
No, it is not.
No. It's my only question. Thank you.
I had the same question. Bob, any questions?
The sale in 2015 of $935,000. Did you investigate that sale?
I did not. It was quite far removed from the valuation date, and obviously in a pre-pandemic environment. So that's a very good question, Mr. Upton. I did not investigate it further.
That's fine. Thank you.
Okay, and I have no questions. So that concludes this property. I think it's probably an appropriate time to take our break. How long do you need, Belen?
10 minutes, please.
Okay, we'll take a 10-minute break then. Okay, welcome back. The next property is 301 Nassau Street North. So Mr. Kupfer, you can begin.
This is roll number 1202-1934-000, street address 301 Nassau Street North. This is again a commercial office building, 2 stories in height, constructed in 1975. We have 8,661 square feet of leasable area out of a total of 12,638. And a 2023 modeled assessment of $1,596,000 that we'll be recommending be maintained today. Scrolling down through the brief, you can see we have no recent sales for the property. Provided you an overhead view as well as a Google Street View. You can see the building shows quite nice for a 1970s building. Again, we're outside of the downtown area, so I've included our OFS suburban office comparable table here. In my opinion, what's being modeled here on page 8 is consistent with those comparables. We have total potential rent of $117,436 by our leasable area. Gives us an average rent being applied of $13.56 a foot, so actually a bit on the lower end. We're applying 6% vacancy, 3% expenses, an $8 per square foot shortfall, and a capitalization rate of just under 6.5% on this one to derive that $1,096,000 value. Everything is on one screen here, so that is the total workup. Provided the income and expense mailer, again, we have a combination here of gross and semi-gross and net rents from what I can tell. Scrolling down through here to their table, they're showing an average per foot rent of $16.28, I believe, so a few dollars a foot higher than what we are modeling. That's their net calculated rental rate. However, they're showing rents here between $45 and $2, so it seems to be pretty inconsistent. I wouldn't put a lot of weight on that. In my opinion, our model is well supported by the comparables as well as the information at hand, and I would ask that model assessment be maintained today. Thank you.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. Mr. Kupfer, you lost me in your, just towards the end there, the page that you're looking at and the net rent you referenced. Is that, oh, I don't have a page number. What page number was that, Mr. Kupfer?
Yeah, I apologize. There's no page number on it. It's the income statement and then the rent roll. And then the one titled 301 Nassau Street, roll number, base rent dash base year by calculation 2020. And they provide the total average dollar rent per square foot, the number of tenants, and then a total net base rent per square foot of $16.28.
Okay, I think I see where you're, so I'm guessing it's page 18. I think it is.
Yeah, we can call it that.
Now, the total area is including the basement space, is 8,661. The total base rent on that, and I'm on that same page now, the total base rent in this, that would be the second last column from the right, is showing as $53,292, correct?
Total net base rent, yes, that's what they list.
So the $53,292, and we've got a leasable area in the departments of 8,661. That would actually be less. That's $6.15, correct?
I haven't done that calculation. That seems correct. Yeah.
And you alluded to it that back on your page 8, the entire evaluation from the potential rent being attributed through to cap rate, that's all monitored, correct?
Correct.
Thanks, Mr. Chairman. Those are my questions.
All right, Brent, questions?
I have no questions, thank you.
Bob, any questions?
None for me, thank you.
All right, then Carrie, you can begin your presentation.
Thanks, Mr. Chairman. Could I ask the board members and Mr. Kupfer to turn to page 14?
Hold on a sec.
Page 14, okay.
14?
Yes, please.
Right there.
Okay. So page 14, the middle, there's two charts on that page. The middle chart is the calculation that we've provided to the board this morning of our total potential net rent. As Mr. Kupfer alluded to, these the rents in place with the subject are gross leases and semi-gross leases with base years. So we've calculated the net rents from the gross and semi-gross rents that are being paid. So you can see on the middle chart, the lease start dates range from, I believe the earliest is July of 18 and all the way through to August of 2020 and September of 2020 for a couple of the small units. So the units in this building are very, very small, as you can see, for the most part. The smallest units actually are 120 square feet up to larger units in the second floor of 1,900 square feet and 1,068 square feet. So the total potential net rent that we've calculated is $79,343. That includes the application of $7.50 a square foot to the finished basement unit of that would be unit 0004, and a net market rent of $8 a square foot for the largest unit in the building on the second floor that would be unit 200. So the total potential average net rent that we calculated is $983. Recall the question I had posed to Mr. Kupfer relates to that chart that the owner had submitted in the now it's not truly a fair comparison in that $6.15 that would not include the rent, any market rent for the basement space, which is why that calculation is lower still. But when one includes the market rents that we've applied, then the total average, as I say, is $983. On the bottom of page 14, we've got a list of comparables. This is the same list of comparables we had for the previous property. It is admittedly coming in higher, but I'd certainly suggest that given the actual performance of the property and all of these leases being negotiated very near the reference date, this does represent in our respectful submission what the property is able to achieve. And in fact, with the application of the market rents to the vacant space is somewhat higher still. The property is, just for the board's information, the property is professionally managed by one of the top managers in Winnipeg, and the rents that the property is able to achieve would be fully realized by this manager and the individuals involved there in maximizing the returns for the property. So the net rents being achieved, again, on page 14, we'd suggest are very much represent the ability of this property to achieve net rents. It is at the lower end of the range indicated by my comparables, but that does truly reflect what this property is able to secure. So then moving to page 16, we've got the valuation, our total potential rent of $79,343, running it through, and in this case, we're suggesting a capitalization of $725. We do note, you need not turn back, but I'll just read from the prior page, the vacancy allowance that we applied is 6%. The actual vacancy rate was considerably higher as of the reference date. Unit 200, that large unit I mentioned of 1,908 square feet, was vacant along with one of the smaller basement units. The actual vacancy rate was over 20%. We're applying the 6% as a stabilized rate, but we are applying then the elevated cap rate of 7.25% in this case to come in at a total value of $903,000. Thank you.
Okay, questions, Mr. Kupfer?
Yeah, so this is the $2.78. You refer to it as a net rent, but it doesn't appear to be a net rent from the comparables table that you've been using this morning, correct, Mr. Reimer?
No, actually, it is a net rent. If you turn, Mr. Kupfer, to page 14. So that chart in the middle of page 14, if you look at unit 201, it's the net rent there of $278 a square foot. Unless I've misunderstood the question. That is the very same rent that's in the chart, yes.
I think I'm misunderstanding the answer. How have you inspected this building?
I've been in it several years ago, not recently.
So what is making this unit rent for $2 a foot and other units rent for upwards of $20, $30 a foot within this building?
Because I can tell you exactly what it is, Mr. Kupfer. If you look, again, I'm referencing the chart on the middle of page 14. This is a short-term lease, as most of these are, starting in June 1st of 2020. So given the vacancy that was already in place and the difficulties this property was having, they were doing the very best they could at the 278, that being just roughly 8 months prior to the reference date. It is low. I do not disagree with that at all. But the alternative is that their second largest unit, in addition to the largest unit, would have been vacant. So they are getting as much net rent as they possibly can in this property for that unit. The risk, of course, being if they're going to hold out for something significantly higher, then they're going to be carrying the two largest units in the building as vacant.
Does this unit, this tenant, have a net lease in place that says you will pay $2.78 per foot per year that you're in this space?
Well, my suggestion is going to be, if we go to my page 25, please. And Mr. Kupfer, just so you know, my page 25 is the exact same chart that you had in your submission as well. So this is the very same chart. So if you go to page 25 and you see roughly a little more than halfway down, call it 2/3 of the way down, there's unit 201, safe and certified. They had the lease expiry on May 31st and they were overholding, but as you scroll right, you can see the gross rent being paid of, I think it's $16,686. And then when you take the gross lease costs off, if you go to the very right, the total net base rent is $29.70, which is $278 a foot.
Well, this gives me more questions, Mr. Reimer. Why is this unit that is a little over 1,000 square feet in space, if I'm correct here, they pay a little over $16,000 annual by net base rent, but they're paying over $10,000 in CAM costs, which represents almost half the CAM costs for the entire building, have been allocated to this one rent, this one unit.
I don't believe that's the case. Where are you getting? Now I'm confused. Where are you getting the total costs?
I'm still looking at your page 25. Safe and certified, right? Unit 201.
Yep.
Where they paid over $16,000, right? And then it shows gross CAM. So $24,983 is the total paid at the bottom. And then it's showing an allocation of over $10,000 of CAM to this one unit.
Well, okay, it's going to be based on a proportionate share, but your earlier comment, Mr. Kupfer, about them paying half the CAM costs or half the expenses, that's incorrect. If you turn back to page 23, this is the income statement for the property. And if you look down that income statement, the total non-recoverable expenses, not including bad debt, were $110,000.
Yeah, I was referring specifically to the CAM costs. How over $10,000 are allocated to this one unit out of the total of just under 25,000. I was wondering why that is for a unit that's only a little over 1,000 square feet out of.
But Mr. Kupfer, with respect, going back to page 23, the total property operating expenses, leaving aside bad debt, are $110,000. If you take off the property taxes, which is 2 lines up, the CAM cost for the remainder of the expenses is about 80. It's not 20.
The CAM costs for the building, you're saying, are around 80?
Around 80,000, yeah, not including taxes.
And the gross CAM listed on your page 25 is 24,983 though, correct?
The
Which is
gross, okay. If you look at this chart that you're looking at on page 25, it's actually setting out two different categories. If it's got a base year, then the base year costs are shown to the right of that column. And I think, if I'm reading this correctly, if it's a straight gross lease, annual gross base rent, they've got the expenses under the other columns. Now, having said that, I'm adding these up quickly, and they add up to roughly 70,000. So even that's not adding up to the total amount of 110,000. That discrepancy I cannot explain, because you're absolutely right. If you add up all of the costs shown on this chart, the 28,000 and then the 8,800 and then the other 25,000 to 9,200, that's only going to be 52,600. That's only going to be in the 70 to 74,000 range. So I can't explain the gap between that and the 110,000 shown on the income statement.
And this total net base rent per square foot, the final column on the right, these are the numbers that you used in your workup, is that right? And for some of your comparables today?
I'm going to say yes. I'm glancing through them. So I'm referencing back. Let me cross-reference it with my chart. My numbers are a little bit higher, but for the most part, they're very close to that.
Okay, that's all my questions. Thank you.
Okay, Brent, any questions?
I have no questions, thank you.
All right, Bob, any questions on this one?
Thanks.
Okay, I have no questions then either. So we will move on to 1797 Logan. Okay, on 1797 Logan, Mr. Kupfer, you can proceed.
This is roll number 1309-102-3200, street address 1797 Logan Avenue. This is a one-story commercial office building constructed in 1962. We have a leasable area of 4,906 square feet out of a total of 5,894 square feet. And a modeled 2023 assessment of 516,000, which we'll recommend be maintained today. My understanding is the space is fully owner occupied, so we're going to be relying on our OFS comparables table here and the information that we have on hand. Page 8 in my brief has the modeled workup. We're calling this just C2 standard space. We have a below average rent being applied here of just over $10 a foot, which I think is reflective of the fact that this is an older building. Again, everything here is being derived based on the model, including the 6% vacancy, the 3% expenses, the $8 shortfall, and the 8.25% capitalization rate, which gives us that $516,000 value. Because the space is fully owner occupied, I don't have any lease information or anything further really to go off of. So at this time, we'll recommend that value be maintained. Thank you.
Okay, questions, Mr. Reimer?
And again, just you referred to it, Mr. Kupfer, but it's model driven top to bottom, correct?
Yes, sir.
Thanks. That's my only question, Mr. Chairman.
Okay, Brent, any questions?
I have no questions, thank you.
Bob, any questions? Is Bob's microphone working? I can't hear him.
Who?
Your microphone. Oh, I don't know. I think it is.
Well, now I can hear you. Yeah. Okay. All right. So, I guess then we're at your presentation, Kerry.
Thanks, Mr. Chairman. Could we turn to page 15, please, of the main submission?
All right.
There is very little to choose from between the department's valuation and our own here. The market rent, I've got a slightly lower market rent, but for all intents and purposes, I don't disagree with the rent applied by the department. The difference then amounts to the non-recoverable expense item, and given the older age, small, that is lower land to building ratio of the subject and the based on where the property is located, we're suggesting a slightly higher cap rate of 8.5. It comes in then at a value of $477,000, recognizing that that is actually quite close to the present assessment, and I'll leave it with the board to make a determination. Thank you.
All right. Questions, Mr. Kupfer?
I have no questions. Thank you.
Okay. Brent?
I have no questions. Thank you.
Okay. Bob?
Oh, nothing for me, thanks.
Okay. Thank you for that. We'll move on to the next property as I open the files. 10008 Wall Street, and there's 3 points of appeal on that. So we will deal with classification and exemptions first, which means, Mr. Reimer, that you're up first.
Thanks, Mr. Chairman. If we could turn initially then to page 16 of our main submission, please.
16.
Yes. So the exemption request this morning is based on the occupancy of the Manitoba School Improvement Programming. This is a registered charity whose object is to assist disadvantaged children and adults with a variety of educational programming, and I'll go through that in a couple of minutes. We believe the organization would fall within 23(1)D of the Municipal Assessment Act as a seminary of learning, or possibly a charitable organization providing relief to disadvantaged children and adults. And we're requesting that the school tax exemption be granted. I've lifted the section from the Act there for the board's reference under 23(1). It says subject sections 25 and 26, property is exempt from taxation for school purposes where the real property is owned by or held in trust for and is used by a college or seminary of learning, or is owned by or is held in trust for and is used by a charitable organization primarily for the purpose of giving relief or assistance to aged, indigent, or sick persons. So starting at page, this is now page 33 of our submission. And this is the charitable organization. This is the registration with CRA that shows the Manitoba School Improvement Program, Peaceful Village Inc., being the registered charity with a registered, the charitable registration number shown there. If you turn to then page 34, and it talks about the programs and activities of the organization. Work to improve learning experiences and outcomes of secondary school students, particularly those at risk, by building schools' capacities to engage students' activity in their learning. This is done by granting funds to school and school divisions. And then if you go to page 37, this is from the organization's website. And they say, first paragraph on page 7, at MSIP, we don't embrace a sanitized version of social justice. Rather, we appreciate the challenge, discomfort, and messiness of how people achieve their potential. Our work is to encourage schools and communities to act out for renewal in diverse ways that suit their context. We recognize that working for social justice and education requires both courage and vulnerability to reimagine, reconsider, and recreate powerful learning opportunities and relationships with students. The mission is to promote educational equity and social justice, collaborating with public secondary schools to build their capacity to improve student learning and engagement. And then on pages 38, there's a listing of the programs that are there, the after-school program and some of the other items they mentioned there. If we turn to page 40, it talks about the Peaceful Village, which is obviously part of this organization. Peaceful Village is an after-school program for newcomer youth and their families facilitated by Manitoba School Improvement Program. Peaceful Village operates Monday to Friday for 3 hours a day, providing students with academic support, learning materials, snack, and other activities to engage with. There are also optional activities for students during PD days and school breaks. Peaceful Village also operates during the summer to provide activities and opportunities in activity-based learning over the break. So again, the organization we suggest might be classified in either of those categories. We suggest overall that they might fit better with the educational opportunities, but they're providing this programming and these resources to individuals who would likely be considered disadvantaged in most contexts. A couple of pages further, this would be on now page 42. They talk about, page 42. They talk about the Passion Projects, which is another program that this organization provides. Passion Projects are activities that allow students to learn and practice skills that they have a passion for. Projects take place weekly and students are encouraged to join at least one. They include activities such as drumming, dance, drama, music, cooking, and sports. The goal of these projects is to allow students to gain confidence and explore their talents, again, with a focus on perhaps those students that are at higher risk. Then 2 pages past that, they talk about the Village Kitchen. That's a monthly celebration where the 5 sites come together to share dinner. It's basically a social activity. And then on page 45, they talk about the adult classes that the organization provides. And they state the Peaceful Village also provides a community for newcomer families and adults through English classes and citizenship assistance classes. So again, I believe it fits more closely, or it's more closely aligned with B section 23 sub 1 sub D, which is the Seminary of Learning. It could also potentially be under sub E, which is the charitable organization providing relief to aged, indigent, or sick persons, the disadvantaged population. Thanks, Mr. Chairman.
Okay, Mr. Kupfer, any questions on the classification liability?
I have no questions. I had a chance to review this property on Friday, and I actually agree with Mr. Reimer. This should fall under 23D, so I'm going to recommend that the Class 40 be applied.
Okay. Any questions, Bob?
No questions for me. Thank you.
Okay, Brent?
I have no questions. Thank you.
All right. Just note this, he agrees with me. All right, then on value, Mr. Kupfer.
On value, we'll have to go through the presentation.
Yes.
This is roll number 13011422600. As we stated, street address 1008 Wall Street. It's a 1-story commercial office building, 5,079 square feet, which is the total gross floor area, as it's only 1 story, 1 premise, 1 tenant. We've got 890,000 is the 2023 modeled assessment, which I'll be recommending be maintained. Page 2 of my brief shows no recent sales and gives you a good overhead view. Page 3 gives you the Google Street View. It looks like they're having some street work done at the time. It's a suburban office property, like I think all the properties we've discussed today. So you'll see the same familiar rent comparables table. Our modeled workup here is using a rate of $13.02 being applied over that total area. 6% vacancy, 3% expenses, an $8 shortfall, and a capitalization rate, which I think is quite reasonable, of 6.5%, which is deriving our value of $890,000 using the income approach. I've included the income and expense mailer at the bottom here, showing Manitoba School Improvement Program. Looks like they signed on for $4,889 a month. Works out to $11.55 net per foot. So our model is about $1.50 a foot higher than what's being paid. All that being said, based on the information I have, we are going to recommend that model value be maintained. And that's all I have on this property. Thank you.
Okay, questions, Mr. Reimer?
So model driven top to bottom, correct?
Yes, sir.
Thanks, Mr. Chairman. That's my question.
Okay, Brent, questions?
I have no questions, thank you.
Bob, questions?
You've got the effective age going from 65 to 99. What have you inspected this property for the improvements?
I haven't inspected this property, no. I'm not able to speak to that effective age very well, unfortunately.
Okay, thank you.
Okay, now Carrie, your presentation on value.
Thanks, Mr. Chairman. Could we please turn to page 15 of our submission? Pardon me. And there's not a lot of difference. It does add up to some extent, but what we're doing is we are in fact applying that $11.55 net rental rate that was being achieved as of the reference date. That was under a month-to-month lease arrangement that remained in place as of that date. The rent of $11.55, we do have a list of comparables on page 13, and it actually $11.55 rent would show at the lower end of that rate. The premise size in this case being higher than the rent comparables for the most part that I've got. So the closest in the rent comparables on my chart would be the 4,700 square feet in Century at $12 a foot. So again, the difference between the total rent between the department's model rent and our own is about 8,000, not quite 7,500 bucks. So it's not a huge difference. We do believe the 11.55 is appropriate, and the other difference, aside from non-recoverables, of course, is the capitalization rate we're suggesting should be 7% in this case. Thank you.
Okay, questions, Mr. Kupfer?
I have no questions. Thank you, Mr. Chairman.
Brent, questions?
I have no questions, thank you.
Bob?
None for me, thank you.
All right, thank you for that. Then we will move on to our penultimate property, which is 1626 Ness. Okay, so Mr. Kupfer, you can proceed on 1626 Ness.
1 second here. Okay, so this is roll number 0756905130, street address of 1626 Neff Avenue. This is a commercial vehicle service related property, fairly new, constructed in 2009. Just one story and 450 square feet of leasable area. And we've got a 2023 assessment being modeled of $1,896,000. The big difference from the other properties we've discussed today. This is a gas station located on the corner of, that would be Ness and, zoom in and see that street. Ness and Madison, so close to Polo Park there, between Century and Madison. I provided a general service kiosk pump station comparables table here. I acquired off of one of our 2017 briefs here, so these leases are a bit older. They provide a pretty good sampling of smaller gas station type properties similar to the subject. I would point you to comparables 2, 3, 8. No, 8 is actually the subject. 10 and 11 are all kind of in that 400 to 600 square foot range, and generally go between about $120 and $180 a foot. These are quite small spaces, and as a result, it really drives up that dollar per square foot. As you can see on page 4 of my brief here, we have modeled 450 square feet for the kiosk at $175.60 a foot. 2% vacancy, 3% expenses, $6 shortfall. and a capitalization rate of 4.8%, derives that value of $1,896,000. Only the one stream on this property, so I'll just summarize it again in the income value summary. Capitalization rate tables. I've included the income and expense mailer, showing that rents are gross, and again, these are pad site rents. That's about all the information I have for this gas station, and again, I'm going to recommend that model value be maintained at this time. Thank you.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. So fundamentally, Mr. Cupper, this is a retail gas bar, correct?
Yes, sir.
And if we go to page 4, you hadn't alluded to it specifically, but I'm pretty sure that the additional building value of $332,000, that's for pumps, tanks, canopy?
That's all correct. So that's added on based on a cost valuation from the 1.563 income valuation.
Right. So the income valuation above that line before the adjustments, that's the that would actually amount to the pad site, and then the other gas kiosk specific improvements for, again, pumps, tanks, and canopy. That's the cost-based value of $332,000. That's added to the income value for the site.
Correct.
Okay. Now going to, and you alluded to this briefly, going to your page. I'm sorry, Mr. Cupper, I don't have a page number. It will be the second last page of your submission. It's the page that shows the rent that's being paid by Safeway for this site. That lease, then, if I'm reading this correctly, that was renewed in October of 2019. I believe if you take that monthly rent, it works out to $50,000 per annum, correct?
Correct.
Okay. Notwithstanding that, the model kicked out a number of 79,000, correct?
Correct.
Thanks, Mr. Chairman. Those are my questions.
All right. Brent, any questions?
Just to confirm, this is the kiosk only, plus the tanks, correct?
That's correct. Yeah, the Safeway is not part of this.
Even though on the mailer they have leased area of 18,000 square feet.
Yeah, I wasn't putting any weight on that mailer, what they had submitted for their Safeway rent.
Okay, thank you. That was my only question.
Okay, Bob?
Well, thank you. No question.
All right. So, Mr. Reimer, you can give your presentation.
Thanks, and I want to get right to Mr. McIntyre's question, actually, because it's really important. That 18,000 feet, that's the land area that's being leased. So recall my question of Mr. Cupper, and I'm very familiar with these gas bar valuations. What you've got conceptually is an income valuation, an income stream for the pad itself, and then added to that capitalized value is the cost, the depreciated cost of the pumps, tanks, canopies, which is of course the assets directly used by the gas station. So the 18,000 feet is in fact the land that's being leased, and there was a renewal in October of 2019 for this pad site at 50,000. Notwithstanding that lease for the property, if we turn to page 15, the market rent that we're suggesting is actually higher still. It's at 67,500, and running it through using the parameters we're showing there, and we're basing this on we're treating this as a retail operation first and foremost. I believe it fits better with the retail category than the office, although certainly it doesn't fit neatly within either. But at the end of the day, this is a retail operation for gas and chocolate bars and chips and what have you within the small kiosk itself. So we've applied a cap rate in this case of 6.5% to that income stream of 67,500, and then we've added. I didn't have the benefit of the department's. Oh, sorry, I seem to be echoing. I didn't have the benefit of the department's valuation details, so I actually applied an adjustment for pumps, tanks, canopies of 392,000. In this case, it's somewhat higher than the department's adjustment of 332 for pumps, tanks, canopies. Now, just briefly, going back to page 13 of our submission, we've got five leases reasonably near the reference date for gas kiosk operations. I don't express them as a rate per square foot. It becomes quite meaningless with these gas bars and these very small kiosks. I do think it's very relevant. And I note that Mr. Kupfer has done the same when you express it as an annual rate. And the annual rates that you can see there in that chart range from a low of 22,000 up to a high of 71,500 rounded. The low rents of 22 and 30, those are much smaller operations by a different operator, and they're quite bluntly, they're not comparable. What are comparable, though, of the two comparable, or the five we've got there, the two locations that would be most comparable would be the Regent Avenue at 58,000 and the Kenniston Boulevard at 71,483. So based upon those lease indicators, we settled on a net rate for this site at 67,500. Again, running it through using a 6.5 cap, which is more along the line of the retail type cap that we'd apply for the property like this. Comes in at a capital value of 914,000, to which we added the adjustment for pumps, tanks, canopies to reflect those actual assets, and then we come in at a total value of 1,307,000. Thank you.
Okay, questions, Mr. Kupfer?
Just some clarification. Yeah, so the 18,000 square feet of land you're saying is being leased at $50,000 a year?
That's the pad lease, indeed. Yep.
It's the pad lease. So that does not include the value for the building either. The gas station has to come in and build their own retail operation as well as the pumps and everything else. Is that right?
No, actually, I'd suggest sorry, I'm going to take a half step back. You're right that the kiosk would need to be built, the 540 square feet. The pumps, tanks, canopies, which represent the bulk of the improvements, are adjusted for by both yourself and ourselves. That actual kiosk hut would the cost to build those small kiosks in and of themselves would be nominal, because of course the bulk of the infrastructure relates to the pumps, tanks, and canopies and everything associated with that. The actual 540 square feet, you're absolutely right. It would be a cost that the operator would incur to build it, but it's going to be nominal. It's a tiny little building.
Okay, thank you.
All right, Brent, any questions?
I have no questions, thank you.
Bob?
You're saying the value of the building is shown on the property, you have no value.
The 540 feet, with the bulk of the infrastructure, and this is really important, the overwhelming cost, as you can appreciate with these gas bars, are the tanks specifically,
right,
and the pumps and the big canopies. The 540 feet, if you're talking about building a little hut like that at maybe $100 a foot, you're talking about $50,000 or something. That's why I'm saying it's nominal. Mr. Kupfer's absolutely right. I'd suggest the pad lease is going to reflect them building in the cost for the hut, but I'm also saying in no uncertain terms that with these small kiosk operations and these small huts, the value in and of itself for the hut is just not substantial.
Okay, that's your opinion. Okay, thank you very much.
Okay, Carrie, on your comparables on page 13.
Yes.
I take it that comparables 4 and 5 are typically like the Domo gas bars that just
exactly.
They just have that little thing to keep the employees out of the rain. And the other ones have a bit of a retail area where they sell drinks and chocolate bars and that sort of thing.
Yeah, I mean the Domo, and you can appreciate, Mr. Chairman, so when you look at the chart, the Domo on Lila at 200 feet is about half the size of the subject, but the key is that those smaller operations, the key driver, not driver, I should say, but the key indicator when you look at these things is the number of pumps. And those Domo sites typically will have fewer pumps. They're single pumps in a lot of cases, whereas this operation and comps numbers 1 and 3 are the much larger ones with the double pumps, similar to the subject.
Okay, and now you're suggesting that the cap rate should be more appropriately a retail cap rate?
I've applied a 6.5%. It'd be consistent with if you look at the department's OFS category, I think the range was 5.9 to 6.6. So I'd be towards the upper end of that. Again, I think if you look at the retail range in the department's model, it's actually, it doesn't fit neatly. The strip would be the closest thing, and that's between 6 and 6.8. So 6.5 is sort of towards the upper end of either, if you classify it in the office category or the retail. We settled on 6.5 notionally as more of a retail property.
Okay, now, if I can ask Mr. Kupfer, then how do you, I should have asked this last time, but I've got a good memory, just short. How do you arrive at the 4.8% cap rate? What category does that fall under?
It's an excellent question. To me, these are the types of cap rates that we generally see for types of properties like surface parking lots, where there's very little money involved in the improvements. And as a result, there's very little risk for the investor because there isn't going to be some large unexpected expense like a brand new $100,000 roof that's all of a sudden going to come in. Like Mr. Reimer has pointed out, the value of the improvements, the value of the actual kiosk on the site is nominal. And as a result, I think the risk would be quite low.
Okay, but in terms of risk then, eventually pumps are going to have to be changed, and especially the tanks will have to be changed. And there's always a risk of leakage, and you see a lot of old gas station sites that are on the contaminated sites list. Does that not go to risk for these sort of things?
That's a fair point. Keeping in mind that the tanks and the pumps, that value is captured in the additional building value, the cost value. Mm-hmm. So that's a number that's driven based on the size, the value, and then it's depreciated based on the age. The capitalization rate that's being applied, the 4.8%, my understanding is that's just to the kiosk, essentially, because that's where the income value is coming from for this property, only from the kiosk, and then the pumps and the tanks are separate in that cost value of $332 on my brief.
Okay, thank you very much on that. So we'll now go to our last property on our largest property, which is 185 Carlton. So let me pull up the files on this. Okay, so 185 Carlton. You can proceed, Mr. Kupfer.
Just 1 second here. Okay. This is roll number 1209-755-9400. Street address is 185 Carlton Street. This is a 6-story office building. We're downtown now, obviously, constructed between 1972 and 1973. We have a leasable area of just under 90,000 square feet and a 2023 assessment of $10,587,000. I believe there might have been some adjustment to that by a member of our staff, because I just have a note here showing that the 2020 assessment was higher than that. It was up a little over $11 million. So I think there might be some consideration done to this property to reduce that. That being said, I am going to recommend that 2023 assessment be maintained at this time based on what I know about the property. We have no recent sales to go off of for this property as far as I can see. I've included an overhead view as well as a few Google Street View images. 185 Carlton. We have this modeled as an OFB. So I've included different comparable lists for you. It's at the bottom of the brief. So you can see the C9, that would be our basement leasable. We'll have lower rates than the standard C2 finish. And we've also got some substandard basement on there at a nominal rate of about $1.80 a foot. We have a high vacancy on this property of 15%. I think this might have been one of the things that was adjusted by our staff here. 3% expenses, $12 shortfall, and a capitalization rate of 6.75%. It's giving us a value of $10,587,000. We have only the one stream on this property, as you can see, is generating an operating income of about $714,599. Like I stated, this is an OFB property, so I've included our OFB marketplace study overview. This was conducted by another member of our team here. I would point to the average and weighted average done at the study, about $14.39, a median of $14, and a min max between $10 and $19 for our OFB marketplace in Winnipeg here. I've included the income and expense mailer below the OFB study there. So they're showing a pretty high vacancy for this property. My understanding is, having glanced over the permits here, I haven't personally been inside it. There's quite a few permits that have been pulled. So I think they're doing quite a bit of work on this building as of now and as of the last year or two, which is why they're getting this vacancy of around 40%. And they're also reporting an operating income quite a bit lower than we would expect. Again, I think attributable to that nearly 40% vacancy. And then at the bottom of that, just the COVID questionnaire I've included. They said that there is a moderate impact and don't really go into any more detail beyond that. Yeah, that's all the information I have on this property. So again, I'm going to recommend that modeled value be maintained. Thank you.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. Mr. Kupfer, you just made the statement that your information regarding the permits that were pulled from is the information, again, I'll take a half step back. The whatever permits you're talking about, I didn't see that evidence in your submission. It's not in there. Is it? Did I miss it, or is it not in there?
I haven't included any permits in my submission.
Okay, and so the information, just so I'm clear, and I don't want to misrepresent what you said, but I do think it's important to understand this. You're suggesting that your information is that the reason for the vacancy is that they're doing work on the property? Or is it the other way around?
I'm not sure I understand the question or the difference really. There is work being done to the property, and there is a reported vacancy of almost 40% on the income and expense mailer I've supplied.
So in your opinion, it was your opinion then, if I understand, because I don't want to misrepresent what you said. In your opinion, the reason for the vacancy is because of the work that's being done and not the reverse. It's not a case where the vacancy rate was very high and the owner is trying to mitigate his losses by improving the building.
To be honest,
go ahead.
I'm not sure I have a good answer for you there, Mr. Reimer. Like I said, I haven't inspected the property. This is what I know about it.
Yeah, no, that's fine. And it sounded like that to me. The way you phrased it, it sounded like secondhand information. So I won't belabor the issue. Did the department, so the department's applied a vacancy allowance of 15%. I think, Mr. Kupfer, correct me if I'm wrong, but that's a rate that would have been adjusted, correct? I'm not entirely sure that would have been a model rate for this building originally, but if I'm wrong, let me know.
I believe you're correct in that. As I alluded to, the assessments come down from 2020, and I know that I think it was Mr. Pohl was recently in negotiations with the municipal board and Altus just to settle past cases on this. So I think it's likely that he probably went in and made changes based on the information that he received through the municipal board case managements there, and then would have adjusted the vacancy upwards again based on the work that's being done and the vacancy that's been reported.
Okay, and were you familiar, and if you haven't had a chance to look at it, that's fine, but did you, were you familiar with the fact that the vacancy rate has actually gone up by 50%, not a 50% vacancy rate, but the actual rate itself has gone up 50% from what it was in 2018 by the end of 2020?
No, I didn't do a historical review of the vacancy.
Fair enough, thanks. The cap rate then, the 675, that's still model driven, correct?
I'm not 100% sure if that was adjusted by the same member of the staff who would have reviewed it, or if it's being driven directly by the model.
Okay, fair enough. Thanks, Mr. Chairman. Those are my questions.
Okay, Brent, any questions?
I have no questions, thank you.
All right, Bob, questions?
Did you review the history of vacancy of this building?
I didn't get a chance to, no.
So the 15% is from another source within your department? Is that what you're saying?
Yeah, I believe 15% would be applied manually by another member of the department here who was recently handling this property at the municipal board for past hearings, because we don't generally see a modeled vacancy percent that high.
Well, if it had been due to improvements, wouldn't your effective year be adjusted?
Yeah, so once those improvements are completed, once the renovations are completed, you're absolutely correct that could necessitate an adjustment to the effective year, and then hopefully a decrease in the vacancy as the building becomes tenanted again, fully tenanted again.
The improvements are a current situation here, is your suggestion.
Yeah, I apologize for not having included that in the brief, but quite a few, at least 15, 20 permits I can see here between 2020, 2022, combination of occupancy, interior alterations, plumbing, electrical, mechanical, lots of permits.
Okay, thank you.
Okay, first of all, there's you've got a high quality restaurant in premise ID 11404. Would that be the Ichiban restaurant?
1881 square feet. Should be able to see that on the income and expense mailer. 1 second here.
I can assist, Mr. Chairman, if you want.
I'm showing 1881 is unit 100 on the income and expense mailer on the rent roll, and vacant as of the time of submission is being reported.
Okay, and Mr. Ramey, you had
That is the Ichiban.
that is the Ichiban. Okay. And the standard restaurant, 11412, is that Shannon's, or is that it shows a Subway on one of the photos?
What was that square footage, Mr. Chairman?
718.
718.
Doesn't seem large enough to be Shannon's Pub. I thought that would be larger.
It's not Shannon's. No, it's not. Shannon's is 6,761 square feet.
Okay.
Potentially Bagel Smith.
Yeah.
Potentially.
Okay. No. Take it this property with its relative proximity to True North Square would probably be affected by although it's not Class A, would be affected by the domino effect from the extra office space coming on the market downtown. Would that be a fair statement?
Yeah, I believe that's a fair statement. Seems like they're gearing up to reposition the building. Like I said, they're putting quite a bit of work into.
Okay. No more questions then. So, Mr. Reimer, you can proceed.
Thanks, Mr. Chairman. Could I ask the board members and Mr. Kupfer to turn to our page 20? Again, I'll frame the discussion for the board's and Mr. Kupfer's reference. The potential rent difference in potential rent is almost zero. There is $4,000, call it $4,400 difference in the potential rent. So we are very, very close with the rents that the department's presented this morning. Quite bluntly, I'm not going to spend any time on that issue because it is so very close. The key points, though, in addition to non-recoverable expense, the single biggest difference is the vacancy. And we've applied an overall vacancy allowance of 20%. I'll get into that in a couple of minutes. We've also applied a capitalization rate in this case, pardon me, at 7%. And Mr. Chairman, to your point, recall from our capitalization rate study, the brokers and the information concerning the downtown office market was overwhelmingly uncertain due to the addition of, firstly, the towers on the first two towers, the second tower being residential with some office space on the second and third floor. The first tower, of course, being primarily office space. And then in addition to that, the announcement of the Wawanesa Tower. So you've got all of that going on, both as to actual competition in the reference date, and with more coming on stream. And in that capitalization rate study, one of the comments from the brokers was that Class B and Class C offices would suffer the most from exactly that domino effect you're talking about. I'd suggest, Mr. Chairman, in this case, the 20% vacancy allowance, if anything, is optimistic. I'd ask the board to turn to our page 16 of our materials, please. And Mr. Kupfer was very forthright in his comments. He hadn't had a chance to look at the historical vacancy. We, of course, have done so. We're familiar with this property. We have been representing this property for a number of years. As you can see there, the vacancy rate in 2013, it was 23%, and then it sort of goes up in successive years to 29%, drops briefly in 2017 back down to 22.8%, and then though by 2020, by the reference date, it was actually up to 38.8%. So the vacancy issues have been prolonged, they've been chronic and very, very substantial, and given the climate that the property is operating in as of the reference date between the pandemic, all the talk about the downsizing in the mid to longer term, and in the increased competition, the 38% reflects those kind of difficulties and is very, very problematic in terms of a prospective investor looking at this. The municipal board, there's a recent case where the municipal board confirmed that where the vacancy rates are significantly higher, it has to be reflected in the valuation. We've done so by the application of a 20% vacancy allowance, but also with the application of the 7% cap. One of the items, and I was personally involved in that case, where this municipal board decision is coming from, and one of the issues that was under examination in that case was where the actual vacancy and the actual NOI was so much less than the NOI being attributed to the property through the assessment valuation, then it is appropriate to also reflect an additional element of risk in the capitalization rate. I'm suggesting that that's exactly the situation that we have here with the 38.8% vacancy at the end of 2020 and the very, very reduced NOI with the subject. That uptick in the capitalization rate, in addition to the 20% allowance, we believe is appropriate. So if one turns to page 20 of our materials, this is where, and we've got the two restaurants, not the smaller one, but the Ichiban and Shannon's. We've got under the separate income stream on the right, the remainder of the office building on the second from the right, and then the total as indicated there. So as I said, our total potential rent is within $4,400 of the assessment department. The difference is negligible. We've got applied a 20% vacancy allowance to the entire property, to the entire income stream, the full 5% non-recoverable, and a 7% cap. The actual, and I'm going now to our page, It would be our page 30.
30?
Yes.
All right.
This is the 2020 operating results, and the at the bottom of page 30, you've got the net operating income of 270,000 for 2020. That, of course, is much lower than what we're attributing with and that's due to the application of the much lower vacancy allowance than actual, as well as some of the other non-recoverable expenses. So with that gap, very substantial gap, we do suggest the 7% rate is appropriate following the guidance provided by the municipal board. So again, so Mr. Kupfer is in a disadvantaged position. To me, it sounds like he's sort of got some of this information secondhand. This building, there is work being done in this building to try and bring it back up to a level that's competitive. This isn't a case, and I stress this isn't a case where the building is vacant because the work's being done and they're trying to get work done and then move tenants back in. This is a case where there's been massive vacancy issues, and they're trying to, as Mr. Kupfer's term actually was exactly right, they are trying in the process of trying to reposition it. But that repositioning is necessary because of the very, very substantial and chronic vacancy issues that it only got worse by the reference date. So certainly my suggestion is that our valuation is very, very fair relative to all of the events up to the reference date, takes into account the uncertainties, takes into account the vacancy to at least some degree, and suggests that the assessment be reduced to $7,538,000 for all of those reasons. Thank you.
Okay, questions, Mr. Kupfer?
Yes, please. Do you know who the property manager is, Mr. Reimer?
I can tell you right through the reference date, it was Morgard.
Okay. So we're attributing this extended high vacancy to the condition of the building you're suggesting is substandard?
I'm suggesting that this is a function of the market and the lack of demand from the market for this building being somewhat dated, needing work and such, and but reflecting a very poor competitive position in the market, reacting accordingly.
Okay. Are you generally in agreement with the calculated vacancy in the OFB marketplace study supplied by the city of about 12 to 13% for OFB properties?
I have honestly, Mr. Kupfer, I haven't considered that. I've looked at the vacancy issues with this property and have applied the 20%. So I have no comment on. I haven't done enough OFBs to do that analysis.
Okay, so the 20% reflects not a market vacancy, but a site-specific vacancy in consideration of the vacancy issues that this property has experienced.
That's very fair. That's very fair.
Okay, and then you further accounted for the vacancy a bit in your capitalization rate, bumping it from 6.5% to 7%.
Indeed, recall, Mr. Kupfer, that the municipal board order that, again, I was involved with, the 20% vacancy was roughly half of what was in place as of the reference date, which was 38.8%. And the gap between our calculated NOI and the actual was $500,000. So absolutely right. I reflected it both in both situations as opposed to just using 30% or upwards of 30% on the vacancy.
Okay, thank you.
Okay, questions, Brent?
I have no questions.
Bob?
No, I don't think so. Thank you.
Okay, Carrie, can you give us that municipal board order number?
Actually, it starts at my page 95 of my submission.
Oh, does it? Okay. That's
It's the property.
Fairfield.
Yeah, it's this property at 75 Sturfield. That's right.
Okay. Now, secondly, on the vacancy rate, typically when a building is 100% vacant, we will limit the vacancy to 25% vacancy allowance to account for the fact that the building itself has value, whether or not there's somebody in it. And I guess that kind of means that the vacancy rates get compressed somewhat as you get higher and higher vacancies. Does your number account for that?
I'd suggest it does for two reasons, and the 25% maximum, Mr. Chairman, actually had an opportunity exactly with the Scurfield decision to go back to some of the municipal board decisions and some of the certs that have been done. They were actually there was a couple of as high as 35, a few at 30, and then a lot of them at 25. What tends to happen is when you go north of 25, or especially around 30% and more than that, you start to get very close to land value. In my submission, though, we're obviously very, very far off from land value in my respectful submission. And when you're taking a vacancy allowance that's half of the actual 38.8% versus 20, we do believe that the 20% certainly is very reasonable. And then going further, and I recognize the board members may not have read that Scurfield decision, but one of the things I talked about was the fact that even when you're applying, in that case, 25%, and in our case, 20%, even with the application of that elevated vacancy, you're not coming anywhere near reflecting the risk to the income stream. There's still a very massive gap between what's actually being generated and the income that we're attributing to the property. And it's the very same situation here where there's a $500,000 difference. The actual NOI is, call it in the $250,000 range. Our calculated NOI is in the 700,000 range. I should actually get that exact figure. Sorry, 527,000 range. So you've got the actual NOI being half of what we're attributing to it, and that's where the municipal board said, yeah, we had a couple of cases where the cap rate, it had been suggested in those previous decisions that the cap rate should also reflect that additional risk, and the board in that case agreed with it. So in this case, to get back to your first question, I'd suggest 20%, and I understand the 25% maximum if you've got 100% vacancy. That's probably, and without knowing all the details, that's getting you fairly close to land value. We're well off of that from here, and the 20% along with the 7% cap rate, we believe, is an appropriate reflection of the risk, and not anywhere near that land value where one would start to question that rate.
All right. Thank you very much for that. Recap on this one, or a summary on this one, Mr. Cupper?
No summary, thank you.
Okay, Carrie, any summary that you wish?
Okay, Mr. Chairman.
All right. So we have heard all the items scheduled, and this hearing is now adjourned. And for the board members, we'll take a brief break and then come back and do our deliberations. Thank you very much.
Thank you all for your time.
Thank you.
Thank you.